The US dollar is the world's reserve currency, central to global trade, even when America isn't directly involved. This dominance was engineered, not accidental, and its foundation is oil. For decades, buying oil meant buying dollars, creating relentless demand for American currency. This exorbitant privilege lets the US borrow cheaply and run deficits with fewer consequences. The dollar's supremacy gives Washington immense geopolitical power, including the ability to impose financial sanctions. After World War II, the Bretton Woods system pegged the dollar to gold, but when that ended in 1971, a new anchor was needed. The US found it in oil, striking deals that required oil to be traded in dollars. This move ensured every oil-importing nation needed dollar reserves, reinforcing the dollar's global dominance. The result? A self-reinforcing cycle where global energy demand fueled demand for the dollar. This system became the bedrock of American economic power for half a century. It shaped international relations, trade, and the daily lives of billions. The story of the dollar is inseparable from the story of oil. And now, that story is beginning to change. The petrodollar system emerged from the 1973 oil crisis, when OPEC's embargo sent oil prices soaring. The US struck a deal with Saudi Arabia military protection in exchange for pricing oil exclusively in dollars. Saudi Arabia also agreed to reinvest its oil profits in US Treasury bonds. This arrangement stabilized oil markets and cemented the dollar's global role. Other OPEC nations followed, making the dollar the world's oil currency. Countries needed dollars to buy oil, locking in perpetual demand for US currency. America could run deficits and print money with fewer repercussions as the world absorbed its dollars. The petrodollar system gave the US powerful leverage. Sanctions became more effective, and interest rates stayed low. This quiet pact between Washington and Riyadh underwrote decades of American prosperity and influence. But the world is changing, and so are these alliances. The US-Saudi oil for security alliance is no longer unbreakable. America's shale boom reduced its reliance on Middle Eastern oil, shifting the balance. Saudi Arabia sees US foreign policy as less reliable and is seeking new partners. China, now the world's top oil importer, wants to pay in yuan, not dollars. Accepting yuan for oil deepens Saudi ties with China and signals a shift in global power. Saudi Arabia's engagement with BRICS and its move to join the bloc show a push for a multipolar world. Selling oil in multiple currencies strengthens Saudi autonomy and reduces US leverage. Vision 2030 aims to diversify Saudi Arabia's economy, and relying solely on the dollar is seen as a limitation. The kingdom is positioning itself as an independent global player, not just a US client. The end of the petrodollar system won't be sudden, but a gradual shift. If oil is traded in other currencies, global demand for dollars will fall. Central banks would diversify reserves, selling dollars for other currencies or gold. This would weaken the dollar and raise US borrowing costs. The US would face higher interest rates, making debt more expensive for government, businesses, and consumers. Globally, economic blocs could form around the yuan, euro, and a diminished dollar. Trade would become more complex, with higher costs and risks from currency fluctuations. US sanctions would lose power, as countries could bypass the dollar system. Nations like Russia and Iran could trade oil outside the dollar, reducing US influence. The global balance of power would shift, forcing America to rely more on diplomacy and military strength. The world's financial order would become more fragmented and unpredictable. The decline of the petrodollar would hit Americans at the gas pump first. A weaker dollar means higher oil prices in dollar terms, raising gasoline costs. Inflation would spread as imported goods become more expensive, eroding purchasing power. Higher interest rates would make mortgages, car loans, and credit card debt costlier. US stocks and bonds could lose their safe haven status, hurting retirement accounts. The exorbitant privilege would vanish, and Americans would feel the squeeze in daily life. While exporters might benefit from a weaker dollar, most households would face higher costs and less wealth. The choices made in Riyadh and Beijing could reshape the global economy and your wallet.